Hello everyone, welcome to Fund Supermart's webinar. I'm Win from the research team. Here a little bit of house rule. Kindly mute your mics so that we can have a very smooth session here. Okay, before we begin, the most important impact from the COVID-19, obviously the humanitarian losses. Okay, and we would like to say that our hearts go all out to the investors as well as people that are being affected directly or indirectly by this incident. Okay, obviously, Fund Supermart's job today over here is to share some of the market movements as well as possible macroeconomic implications that are coming or have induced due to the COVID-19 incidents, and how would these actually translate to market movements going forward. So without further ado, let's move on to the agenda of the day. We have five sections. I have quite a lot to share with you guys today, so please bear with me. Mainly five agendas. So we actually walk through the COVID-19 statistics first across the globe. Then we will actually have a quick review on the macroeconomic snapshot across the globe. Then we will actually follow by the market performance to date. So in that section, we will actually look at some of the valuations of the global equities and which markets are actually looking attractive. Then we will move on to identify some of the potential winners of tomorrow, where we think offer investors a very attractive upside potential. Then lastly, we will actually discuss what investors can do. So before I proceed, please remember to mute your mics. Okay. First part, regarding COVID-19, cases beyond China has actually expanded or increased at a very alarming rate over the month of March. So all of these uncertainties, as well as the progress within the developed markets, as well as other regions, have actually translated to a very volatile market regime, because market participants and investors did not see that coming during the month of February. So at the beginning of February, back then, cases were actually quite concentrated within China. So over here, looking at the chart, you can see that over 99% of the cases are actually within China. But that situation has actually changed as we move across March. And currently, China has only accounted for 6.5% of the total number of cases. So in response to that, health authorities and governments are actually stepping up their containment measures. Okay, and that has actually resulted in some of the daily growth rate, moderation in daily growth rate in the cases beyond China. So that is actually portrayed by a gradual decline in the blue line, although the absolute number of cases remains quite worrying. Looking within death rate, I think in terms of the death rate is only one of the positive aspects of COVID-19. Why would I say death rate comparing to influenzas such as SARS, Ebola, as well as MERS? The death rate is actually a lot lower compared to the previous influenzas that we have been through. Having that said, cases beyond China, the death rate is actually gradually trending higher, because the infected individuals beyond China has actually pre-existing conditions such as cardiovascular cancers, as well as other sort of cancers that has actually weakened their existing immunity. Next, we will actually look at a comparison in terms of evidence of virus containment. At this point of time, although the absolute number of cases on a daily basis across the globe has actually started to trend lower, okay, we don't think this is a very solid evidence of virus containment yet. Okay, we will continue to monitor the situation, because if other countries is any guide, okay, we have taken as one of the successful cases. So we will actually attempt to monitor and see if there's a trend of a very consistent decrease in terms of the number of cases across the globe. And eventually, these number of cases should plateau or flatten off, just like what we have seen for the cases in South Korea. So good news is global confirmed cases have started to come down due to all the restriction orders, movement restriction orders that are put in place. But we don't think this is a very this is a confirmation sign, yet we will still have to monitor in terms of the number of cases in the next 1 month to 2 months to get a very sure sign of the progress of the containment. So, long story short, in terms of the COVID-19 statistics, is uncertainty surrounding COVID-19 is here to stay. Okay, we have seen encouraging signs. Global number of cases has started to plateau as a result of increase in movement restrictions, but we are very watchful for early complacency from authorities. The dilemma here for governments as well as health authorities is that we are actually battling against the disease as well as economic downturn, a recession. So if you release people too early, removing those distancing measures too early, you are taking a risk of a second outbreak, okay, due to the asymptomatic nature of the virus. But if you keep people in place for too long, okay, it's very hard for you to kickstart the economy. Okay, so we actually hope that the health authorities and governments will actually exercise very prudent measures when it comes to deciding whether or not these restrictions should be in place or be removed going forward. And if you want our thoughts on whether or not MCO is going to get extended, we think the chances are it's very likely. Okay, although the daily growth rates for the cases have actually started to moderate downwards, it hasn't really decreased in a very consistent manner. So that is why we think the Malaysian government will likely extend MCO. And even for guidance sake, okay, we do not expect a complete open up of the economy, not only in Malaysia, even for the affected countries like Europe as well as US. So these countries that are being affected by COVID, right? We think a more proper measure that they can open up the economy is in a gradual manner, just like how the state of Wuhan has actually opened in this week. So although their cases have plateaued, although China's cases have actually plateaued across February and March, they did not actually open up to they did not open up the economy immediately. It's a very gradual manner, phase by phase. They started off with essential services first, then followed by those that are more important. Then gradually they phase out towards consumer discretionary as well as retail stores, and lastly they open up the borders. So we think going forward, although market participants are actually expecting a V-shaped recovery after COVID-19 has settled, we think in the meantime, the V-shaped recovery might not appear as sharp. We think it will be more likely like a U-shape, because it is unlikely for the government to just one shot release all the restriction measures. It will likely be in a in a planned manner. So we will continue to monitor the developments closely. Moving on, having known the COVID statistics will actually shed some light on the current macroeconomic situation. Across the globe, global PMI has actually plunged on demand shock. Okay, containment measures and various fears have actually hammered production capacity very significantly. Okay, for those of you who are not aware what is PMI, PMI is actually the Purchase Manufacturing Index. It is one of the measures that allow you to gauge the health of the economy. So when manufacturers are increasing their production, increasing their activity, the number of PMI will actually register value above 50. Okay, any values below 50 is actually representing contraction. Okay, so back in 2017, where we see a very rosy picture for global equities, you see that global PMI is actually hovering in a very strong territory near 55 level quite consistently. Then going into 2018, when there's a trade war coming in, trade tariffs hammering export and import activities, you start to see PMI numbers trending lower, nearing towards 50 level. And just when we are about to pick up towards the second half of 2019, okay, you see the numbers slightly uptick there. The COVID-19 impact has actually dragged down all production capacities due to the shutdown measures. So this is what the markets are actually looking at now, and the equity prices, risk assets have actually priced in this uncertainty. And another gauge to look at the global economic health is actually commodity prices, okay, because you require commodities to produce as a raw material to produce end goods, consumer goods. So an uptick in demand, a pickup in economic momentum is actually reflected through commodity prices. So over here I put down 3 arrows. The first arrow is actually in the 2017 period mentioned earlier. That year is where we see a lot of uptick in terms of global economic activity, a synchronized global economic growth. That period you see commodity prices gradually trending higher. Then when trade war comes in, Trump fights with China, you see commodity prices started to bottom. And 2019, where we see lesser trade uncertainties. So when US and China started to talk with each other, started to establish some common grounds, you see commodity prices bottoming already. And in the recent times, due to the COVID-19 incident, we see a sharp fall in terms of commodity prices. So with that, we actually expect emerging economies to be hit the most in the first 2 quarters of 2020 because like it or not, although emerging economies have been trying to transition towards more consumption-led growth, a lot of their growth are still coming from exports, especially commodity exports. So one of the prominent country that I can mention is the Australian economy. Okay, they are heavily correlated with the global economic picture. So due to COVID-19, we see a lot of hammer in terms of, we see demands get hammered, and that is why you see Australia's economy as well as its currency being sent to historical low. Okay, although the first 2 slides that I mentioned earlier is painting a very gloomy picture, we think investors can actually draw comfort from the policy measures that are being put in place at a historical pace. Looking at central banks, if we compile some of the markets under our coverage, most of the central banks have actually eased their interest rate. So how do you interpret this chart is that back in 2019, the green dot actually represents the interest level back in December 2019. So currently, interest rates are actually a lot lower. You see a lot of blue bars are actually hovering below the green dot. So that actually shows you that central banks across the globe have actually moved towards an easing stance to preserve economic growth. Then aside from monetary easing, you also see governments are actually releasing measures at a historical scale as well. So over here, my colleagues have actually helped us to compile some of the policy measures that have been released over the past 2 months. The list is not extensive because every day there's a very large news flow coming in. So we apologize for not being comprehensive enough, but this is as of latest available at the time of preparation. Okay, so the main takeaway from this picture is that policymakers have not dealt with this kind of situation before because the characteristics of the previous virus is we will be able to quarantine those that have shown symptom quite quickly. So it allows us to actually quickly contain the spread. But due to the COVID-19's nature, it's very hard to really identify the contact point of the infected individual. So that is why governments are actually dealing with something that they have not been dealing with for a very long time. So to respond towards unprecedented shock, okay, we actually see unprecedented record stimulus coming from governments as well. Okay, so summing up the macroeconomic picture, okay, leading economic indicators are actually reflecting the current situation on the current impact from COVID-19 on the economy. Okay, we do not expect the headlines to go positive from here. We think there's a lot more negative news flow to come. So the first thing that is probably on our minds will be the US quarterly earnings result coming out this month. Okay, so that will actually give analysts a sense of how bad the situation is because containment measures are actually being put in place during the month of March. Then over the second quarter earnings results are likely going to be impacted by the containment measures that are being held throughout April or even May. So over the next 3 to 6 months, we actually expect headlines to turn to still remain quite ugly at this point of time. So we actually expect a lot of volatilities ahead. Okay, but as I mentioned earlier, I don't think it's the end of the world. Okay, and policymakers are actually stepping in very quickly to curb or try to cushion any potential impact towards the economy. They are doing whatever that they can to help companies to weather through the period, to help consumers to sustain their job, maintain disposable income to prevent further drawdown in terms of the economic momentum. So ample liquidity and relaxation in the financial system, this is what we have seen so far, okay, and it allows corporates to actually refinance their obligations at a lower cost. So this is very important for them, for companies that are facing working capital issues, facing liquidity, and this will also help them to keep their employees' jobs. Then on the government side, stimulus and guarantee programs have been laid out to help reduce unemployment as well as reduce income losses. So the impact of the economy is expected to be severe. This is, I think, inevitable. Okay, markets are actually putting in low expectations in terms of growth numbers and earnings numbers already. But although growth shock is imminent, we think the policy response that are being put in place now will actually set a stage for a stronger recovery in the medium to longer term. Okay, so we have already gone through the statistics, the macroeconomic snapshots. Now we will actually look at the market performance. How have markets performed so far in 2020? So this year, the market movements that we have seen is definitely something that we have not seen for a very, very long time. Okay, March 2020, the daily volatility that we have witnessed over the past 1 month, the last time this has happened was in 1929. Okay, that is I think more than 90 years ago. What has actually caused all this volatility? Why can markets behave in such a manner? Is due to the rapid news flows coming from different countries that are published on the news headline. They are all negative. They are spreading a lot of fears and worries around the uncertainty of COVID-19. So over here, I've actually put in a timeline. It's not comprehensive, but it shows some of the major news that has taken place over the course over first quarter of 2020. So if you compare the volatility numbers that we are looking at now back with the environment that we are in during the trade war, I think the trade war feels a lot better now compared to the current situation. Okay, so where are markets today? So we have actually put in return numbers from the peak of 2020 in the respective markets to the low to the record low that they have reached in March. So these numbers, the peak to trough numbers, is actually represented by the red dot. Okay, I believe for those of you who have followed the market closely, you would have been aware that markets have actually rebounded quite swiftly over the past 2 weeks. Okay, so currently, from the peak to current picture, the blue bars will represent the numbers. So on a year-to-date basis, all markets are actually making losses. And surprisingly, this time round, China is actually the more resilient market compared to the developed markets. So have sentiments recovered in the recent rebound? We don't think so. Okay, at the beginning of the year, you see the green bars. Those are actually the net inflows coming from foreign investors into the Asia economy. So over here in Asia, we have it actually consists of 7 countries. I put in the slides at the bottom there. You can take note. It's Korea, Thailand, etc., etc. So at the beginning of the year, the easing trade tensions as well as the phase 1 trade deals have all putting in optimistic picture for the global economy to recover, and that is why foreign investors have been gradually coming back in to the Asia equity market. But the development of COVID-19, especially towards the end of February, foreign investors have actually pulled out of their capital from the Asian and emerging markets region and put those back to USD denominated assets, particularly US treasuries. So despite the rebound that we have seen over the past 2 weeks, foreign investors are still the net sellers of the Asian equity market. In year to date, they have actually sold off $45 billion worth of Asian equities. Okay, so after the sell-off, what's left? I think this is one of the most important charts that investors should pay attention to. It allows you to identify what are the companies or what are the economies that are offering you very decent growth potential at a bargain. Okay, so how do you interpret this chart is that the red dots will actually show you the valuation level, the PE level before the outbreak, before the COVID-19. So this is as of 15 or 16 January, but it's definitely before the first news posted by China. So that's the red dot. current valuations is actually represented by the blue bar. Okay, so a glance across, most of the markets have their blue bars below the red dot. It means that markets have corrected in terms of price. The green line is actually our in-house fair PE ratio. So usually when markets are trending below our in-house fair PE, we will actually look into these markets as they offer a very decent upside potential. But having said that, are the current earnings numbers reflective of the impact of COVID-19? Okay, over here I've put in another number, a picture for all of you to see. Okay, this is actually the earnings revision for all the economies under our coverage. Okay, what is earnings revision? Okay, so for instance, I'm an analyst for company A. Okay, I expect company A to earn $100 in 2020. Okay, if the earnings revision is negative 14, okay, it means that I expect company A to earn 14% lesser in 2020. Okay, so meaning to say that I started the year with 100 ringgit, I expect it to earn 100 ringgit. As time goes on, I expect COVID-19 to affect the company's revenue and profit. So I revise my earnings estimates downwards. So that is how we actually gauge the pessimism and optimism within the consensus within the markets. So as you can see across the board, all of the equity markets around the world, they have actually witnessed downward revision in earnings, which means that analysts are actually expecting companies' profit to fall further due to the impact of COVID-19. But are these estimates or earnings revision pessimistic enough? Okay, so we do not think these estimates may be pessimistic enough because due to the unprecedented nature of the COVID-19, it will take some time for market participants to actually account for the impact towards the earnings number. So as the first quarter earnings starts to release in this month, okay, we think analysts will have a better idea on how to adjust their earnings downwards further. So we have actually done our own forecast. Okay, we put in two bearish scenarios. First, we did a haircut of 15% further from the current estimates, which means that the analysts outside have actually put in a downward revision of 14%. Okay, based on these 14% numbers, we actually cut another further 15%. Okay, we expect things to be a lot worse. Okay, and we put these estimates against the current price so that your PE will not look too cheap. Okay, when the earnings numbers are not accounted for properly, PE values will actually be misleading. Okay, so even after putting in earnings hack of 15%, okay, as represented by the blue bars, there are economies that are still hovering below our fair PE. It means that if these companies perform worse than expected, okay, we have lesser downside risk because we have actually accounted for the downward revision in potential further downward revision in earnings. But if companies are able to deliver better than expected earnings, we think these economies would provide even further upside potential to our investors. So the box circled in purple represents the area that we will look at when it comes to looking for attractive investment ideas. So we have discussed market performance, we have discussed market valuation. So now I will actually share three investment ideas to all of you here, okay, to be able to invest in these avenues to capture growth opportunity. So the first idea, which is also my personal favorite, is Chinese equities. We don't really expect China to actually derail from its long-term growth trajectory despite COVID-19. Okay, the macroeconomic story concerning China is still there. Okay, they have transitioned from investment-led economy back then, from everything made in China to e-commerce, to retail consumption, to your retail spending. So instead of back then, where in the period of year 2000 and 2010, the Chinese economies are relying on investments as well as manufacturing activities to spur economic growth. So today, more than half of their growth is actually reliant on the expenditure of the Chinese people. So the transition, we believe if China has not made the transition towards the consumption-led growth, today they will be facing a lot more difficult picture compared to where they have been in the past. So that is what we actually like about China in this matter. And in the long term, we think this will continue to pick up. Okay, eventually, we think it will actually emerge towards the developed market strength. So for context, US economy, 70% of their growth actually comes from their domestic consumption. For China, it's about 50% only. So we think these numbers will gradually converge. Then apart from that, if you compare China with the other developed market economies like Japan, Europe, or even US, their demographics are still a lot more favorable compared to them. And apart from that, they have actually relaxed their one-child policy. So in the next 10, 20 years, you will have a new wave of young people, young workforce that are there to contribute to the economy, and they are there to consume. Okay. Thirdly, which is one thing that we actually pay attention to when it comes to assessing attractive markets, is monetary ammo and fiscal policy maneuvers. We think China has a lot of ammo when it comes to handling external shocks. So earlier on, we have actually mentioned that we are not sure whether or not COVID-19 will continue its downward trajectory. There is a possibility of a second outbreak. So what if we were to look at the worst case scenario, we look at a second outbreak across the globe? Which countries can survive the second outbreak? We think China can likely survive because they still have a lot of monetary ammos as well as fiscal ammos available. So if you look at this chart, this is actually the fiscal deficit to GDP numbers for China against the other developed markets. So China is actually sitting at 1+%, negative 1+% fiscal deficit, and US and Japan, in comparison, they are 3 to 4 times more compared to China. So when it comes to easing measures, we think the Chinese government can actually do more if necessary to prop up the economy if, let's say, we have a second wave of COVID-19. Then European side, their fiscal deficit is actually quite low because of the sovereign debt crisis back in 2010. So that at the point of time, a lot of European governments are being forced to oblige with the new austerity measures. So the European government has actually cut back in terms of a lot of social security benefits as well as their fiscal expenditure. And that is why over the past few years, you don't hear much people talking about Europe when it comes to investments. It's quite gloomy there. But I think the austerity measures that are being put in place back then is actually quite useful for them now. It allows the European governments to actually put in a lot of funding to combat against the COVID-19 impact. In terms of valuation, Chinese equities are actually looking very attractive at this point of time. Okay, over here we have the A shares valuations as represented by the Shenzhen 300 index. Currently, the PE value is actually hovering near the -1 standard deviation level. So a mean reversion back to its historical average PE will actually provide you more than 20%. We are looking at more than 20% upside potential for Chinese equities by end 2021. So for those of you who like A shares, it's actually sitting at quite a bargain. So on the other side of the story will be H shares. So for context, H shares are Chinese companies that are listed in Hong Kong Exchange. They too are presenting a lot of values for investors at this point of time. The current sell-off has actually brought historical valuations towards a very attractive level, and we think this is one area that we really like. So this H share is actually represented by the Hang Seng Mainland 100 index. So after discussing our favorite country, favorite markets when it comes to equity investments, we would like to share our thoughts on two sectors that we like for long-term play. Okay, how do we identify these winners? We actually categorize them. We find that they have three common traits. The first one is actually the long-term mega trend. These sectors are able to tap on the long-term mega trend that are existing in the globe currently. Secondly, they have a huge market potential. Okay, a huge market potential will allow these companies to grow further and allow the industry to grow better instead of looking at the sunset or saturated market. Then lastly, these sectors will have to be sort of recession proof. Okay, demand for them will continue to come in even in challenging market periods. So the first sectors that we would like to share with all of you is the tech sector. Okay, we believe the artificial intelligence initiative, aside 5G infrastructure push, will continue to drive the tech sector. Okay, tech companies have been trading at a very expensive premium. For investors that have followed the US banks very closely, you will know that they actually trade at crazy PE levels. But we think these PE levels are actually justified for their long-term potential as well as the earnings growth potential. So although tech companies are the most expensive among all industries in the US equity market, the correction that they have experienced is actually the least. So energy sectors is actually the one that are being hammered the most because they are sort of a sunset industry. Not to say sunset, but the outlook for oil hasn't been very encouraging. Then we have COVID-19 issue coming in, which hammered demand for fuel. People are not traveling as frequent anymore. So in relevant, tech companies are actually a lot more resilient, although they have corrected quite a fair bit also. Then aside from that, in this crisis, in the current crisis, we think the social distancing measures as well as work from home policies have actually accelerated the demand for tech. So you and I cannot see each other today. So in order to transfer goods or even transfer information between each other, we will require cloud services, we will require established web services. Then apart from that, due to the virus containment measures, government and authorities or even companies are looking to reduce human touch. So this will actually also drive the adaptation of automation as well as kiosk around the globe. So all of these things are actually a permanent change or change that are coming but has been accelerated by the COVID-19 incident. Then last but not least, the global aggregate demand for technology advancements is intact over the long term because I don't think a COVID-19 incident will actually stop you and I from acquiring better tech products or driving cars with better smart features or even stopping us from adopting smart home technologies in our respective residents. So all of these trends will actually be able to help support the long-term growth picture as well as demand for technology companies, goods as well as services. So we have put in the penetration rate across the globe. Okay, it is separated by region. The world population, most of the world population is actually residing in Asia now. More than half of the people is in this region. However, the penetration is actually a lot low compared to the developed markets. So 1 out of 2 individuals in Asia have internet access, while 8 out of 10 people in Europe have internet access. So this low internet penetration rate actually represents a very huge market potential for these tech companies. Then aside from that, as I mentioned earlier, COVID-19 has actually accelerated the demand. So usually for internet facilities and infrastructure is a lot more accessible for urban areas. But due to the movement restriction measures, those kampung areas back then, those auntie and uncles back then that have been accommodating uh, more on the ground movements. Okay, they are being forced to move toward e-commerce to acquire their consumer staples, to acquire services and necessity. So all of these movement restriction measures have actually pushed a lot of people that are not within the they are not adapting technology as much towards the technology space, and this will actually help these tech companies to tap into markets that they have previously unable to reach back then. In terms of valuations, although valuations have corrected for the tech sector, they might still look expensive from a historical perspective. If you look at the period between 2017 to 2018, the technology companies has been around one standard deviation level. And once the trade war settled down, we actually see valuations gone off the roof and have corrected towards the one standard deviation level in recent period. Is it a good time to buy tech now? I think it's still a good time to buy tech now because all of the long-term prospects are actually pointing towards a very healthy adaptation towards technology. And you might not catch the bottom, but in the long term, tech is here to stay. Okay, so we also think that is why technology equities may actually command additional premium for its long-term growth prospects. Moving on to the next sector that we like the most. I didn't put the name here, but I think you guys will know what I'm talking about. Aging is inevitable. Okay, so this is one of the big macroeconomic trends that are there for the healthcare sector. Okay, why is that so? The healthcare awareness has been improving quite substantially over the past few years due to the ease of access towards information as well as the improving income of the consumers around the world. So as the living standard moves gradually higher for the consumers within Asia or within the consumer segment, it will actually help to increase demand of health supplements as well as goods and services. And apart from that, these healthcare companies are at the forefront of combating against diseases. So they have been putting in a lot of research patents to capture, so to be able to refine solutions to handle cancers as well as new diseases. So we think this is actually an ongoing battle, a long battle for the human race against the disease, and the tech companies and the healthcare companies will be able to champion these disease or research initiatives. Then lastly, sustainable demographic trends is actually a permanent tailwind for the healthcare sector. A favorable demographic trend is what we are looking at here. So the purple line over here represents constant fertility. So what is constant fertility? It means that you and I continue to produce babies at the rate that we are producing babies at the point of time. Okay, if that happens, if people continue to produce babies at the current growth rate forever, we will actually see people, the population going younger. Okay, that is why the median age starts to plateau over the long term. But if history is any guide, if you look at the trend between 1990 towards 2020, we actually see a gradual increase in terms of the median age of the population around the world. So that actually tells you that the fertility rate around the globe is actually decreasing. Okay, so if we maintain a high fertility rate but gradually decreasing, the red line is actually what you are going to see in terms of the median age. It will increase but very slowly. But if fertility were to fall off in a more significant manner, median age will actually start to pick up. Okay, it means that the global population will grow older and faster. So that has actually resulted in a branch in terms of the blue line as well as the green line. Okay, so earlier on I've actually mentioned the healthcare companies are at the forefront against diseases. So have we won the war yet? We are far from winning the war. Looking at the data provided by IHME, okay, global deaths across the globe, more than 50% of these deaths are actually disease related. Okay, and healthcare companies are constantly putting in measures and initiatives to drive down death rates related to diseases, and we think the battle is far from over. So that also provides a very good prospects for the healthcare companies in the long term. In terms of valuation, healthcare is looking very attractive at this point of time. Currently, the PE ratio is standing at -1 standard deviation. So historically, there's not much occasion where it goes below that level. So the last time we have seen this is actually in January 2016, beginning of 2017, as well as the trade war period, which is September and November, which is the January and November 2018 period. So given its long-term attractive fundamental story, we think healthcare companies is actually quite a decent investment opportunity that investors should consider in their portfolios. Okay, so over here we have actually put down fund recommendations to write on our bullish view. For investors that share the same view with us on Chinese equities, they can consider CMB Principal China Direct Opportunity Funds or CMB Principal Greater China Equity Funds. So these two funds actually provides you two different exposure. The former will be able to provide you with A shares exposure, so you are directly invested in the mainland Chinese equities. The second one will be able to provide you H shares exposure, which means you invest in Chinese companies, but they are listed in the Hong Kong Exchange. For those of you who share the same view, in terms of tech equities, you can actually invest into TA Global Tech or Eastspring Investment Small Cap Fund. So some of you might be curious, like, Eastspring Investment Small Cap is a Malaysia small cap fund. What relation it has with riding on tech equities? For the small cap space in Malaysia, a lot of players are actually residing within the semiconductor space. So that is also why the small cap sector's performance is actually quite related, or to say closely correlated with the exports as well as the global economy. So if you want an example, last year, Malaysian markets was one of the worst performing markets across the globe. But the small cap performance have actually registered more than 20-30% in 2019. Why? It's because of the improving trade relations between US and China. So once those tensions got resolved, exports companies are actually able to benefit from better trade activities as well as global aggregate demand. So another way for investors to, aside from buying into tech funds, you can actually buy into semiconductor companies, which the exposure that you can get from the Eastspring Investment Small Cap Fund. So that will actually allow you to ride on the demand of tech as well as the secondary demand for semiconductor products. So lastly, for investors that are looking to ride on the long-term healthcare trend, you can actually consider United Global Healthcare Fund. So this fund is one of the top 3 available healthcare funds that are available in the world. Okay, they are managed by Janus Henderson, one of the prominent foreign fund house that are managing multi-billion dollars of asset in US. Okay, we have discussed the macroeconomic picture. We have also discussed some of the attractive markets as well as the funds that you can look at to tap on the investment opportunities. So I would like to put in a takeaway here for all of you. So I would like to reiterate again, we expect a weaker headline numbers over the next 3 to 6 months. Okay, although current market has rebounded, we think there could be volatility ahead because of the earnings results numbers as well as headline numbers that are coming in over the next few weeks. Okay, the uncertainty surrounding COVID-19 contributes to most of the downside risk to our scenario. Okay, what we are looking for here, or what investors should look for, is a progressive decline in terms of the infection rate. That will actually mark the beginning of a successful virus containment. But you need to be watchful of early complacency. You need to be very fearful or be very cautious in terms of managing the second outbreak. So although COVID-19 has actually dragging economy towards a recession, we think the recovery scenario is still there. It's just being postponed by COVID-19. After the recent rebound, equity valuations are still looking attractive, even after accounting for pessimistic scenarios by adjusting the earnings downwards further. In terms of asset class between equities and fixed income, we are positive on Chinese equities, and we are positive on equities, and that is why we maintain an overweight position of 5% in our portfolios. So to give a context, if you are a balanced investor holding 50-50 allocation between equities and fixed income, an overweight of 5% in equities, it means that you have 55% equities and 45% fixed income. Okay, and within geographical regions, we are actually very positive on Chinese equities, okay, for its longer term growth prospects as well as attractive valuations. And looking into sector plays, we are actually positive on technology and healthcare. These sectors provides you an avenue to tap into longer mega trends, huge untapped market potentials, as well as resiliency against economic downturns. Okay, we have actually reached the last part of our presentation today. Okay, so what can investors do? I think in this session, I will actually address some of the concerns that you guys might have after witnessing the recent rebound. Will markets fall further from the current rebound? For humanity's sake, we hope the virus containment is moving towards a successful trend. Okay, and we certainly hope the market doesn't correct further. Okay, but historically, it's possible. So over here, I've put in 16 bear markets instances of the S&P 500 since 1929. Okay, out of the 16 instances, excluding the current one, you have 4 instances where you have intermittent market rallies. So what do I mean by intermittent market rallies? So if you look at this chart, okay, I've extracted the 4 instances: the Great Wall Street crash, Great Depression, World War II, tech bubble. All of these is a very long-term bear market. As you can see, a number of days can stretch from 1,000 over days to few hundred days to 1,000 over days. Okay, so in between these markets, there are actually intermittent rebounds. So rebounds of more than 20%, we actually identify them as intermittent bulls. Okay, bulls that occur in the middle of a bear market. Okay, so if history is any guide, plus the uncertainty surrounding COVID-19, we do think there are chances that there's a fair chance that market can trend over the near term. Okay, but having said that, we think investors should still remain invested. Okay, why? It's because valuations are still attractive. Okay, and for investors that have stayed on the sidelines for a very long time, not doing anything, we think that you should start buying progressively. Okay, we are not asking you to go all in into markets now. It's very difficult, or to say impossible, to catch the market bottom. Okay, so how do you invest in a bear market? So you can actually exercise a strategy called dollar cost averaging. It means that you separate your capital. Let's say you have $100, you actually carve these $100 into 25, a chance of four chunks of equal portion. You can invest these monies in a consistent manner in terms of period or in terms of market drawdown. Okay, and you actually demonstrate how you can do that later. Okay, and lastly, be prepared for additional volatility ahead. So although you are investing in a low period, in a low level, okay, we think that investors should not expect immediate market returns. Okay, so given that there are still a lot of volatilities ahead, if you have invested into the market, be prepared for further drawdowns. And in terms of how to invest progressively, there are 2 ways to do this. You can either follow by a consistent periodic manner. It means that I buy, let's say, every 3 weeks, or I buy every month. Every month I set a date, be it the beginning of the month, end of the month, middle of the month, whatever that suits you. I separate into 4 chunks and I invest separately every month. So that is one way to do it. If you are looking to average down your costs accordingly based on market movements, you can actually set in price levels and decide to deploy your capitals accordingly. So over here, I've actually put in a table for your reference. Okay, so the first purchase represents your first deployment of capital. Second purchase represents you buying a second time. So if you buy every 3% drop, okay, after 4 capital deployments, you have successfully reduced your investment cost by 4.5%. Okay, so if you buy every 7% drop 4 times, after the 4th purchase, you have actually be able to lock in, or to say reduce your average investment cost by 10.6%. The bigger drop that you go for, the more that you will be able to average down your investment cost. So this is another way for you to do, or to say another way for you to invest progressively, aside from putting in money over a consistent period. Okay, so we think investors, although markets have rebounded in recent periods, we think there are still a lot of opportunities out there, and it is a very good time for you to look at attractive long-term growth avenues and start building positions progressively. So as I said earlier, you can actually consider technology companies, you can consider healthcare companies, you can consider Chinese equities, and these are actually very good they provide you a very good long-term growth story. And one thing that I think is worth highlighting to unit trust investors is that COVID-19 is exerting a different form of impact to different companies. Okay, for energy companies, they are looking at very low oil prices. They are looking at capital investment losses because they have invested to drill oil, but the amount of money that they are getting back by selling the oil is not much. For tech companies, they are looking at reduced consumer discretionary purchases, but they are looking at increasing demand for server capacity, for cloud computing, for conference capabilities. So every industry, or even for each industry around the economy, we have different winners and losers, and we think Chinese equities, technology equities, and healthcare equities provides you a very good growth story. And when it comes to deciding what to buy, unit trust investors have lesser concerns of that. Because if today I were to invest my money in a particular company, I need to be very aware of the risk that I'm taking, because I'm putting my money in a single company, maybe a few companies, but it's still quite limited in terms of the number of shares or companies available in a unit trust. So I have to be very stringent and careful in terms of choosing companies that are able to weather across the current downturn, okay, and will emerge stronger when everything goes back to normal. But if you buy unit trust, all of these homework, underlying fundamental research, whether or not these companies have very good solid ground in terms of handling economic crisis, all of these work are being done by the professional fund managers. So in the sense that unit trust investors just need to identify the long-term trend winners. They don't have to bother much in terms of, oh, the fund manager is buying Alibaba, the fund manager is buying Maybank, the fund manager is buying ABC. They don't have these kind of concerns. The fund manager will help them to choose stocks that are fundamentally good. They just have to ride on the macroeconomic trend. So in periods of crisis, I think unit trust funds do provide investors with value, as well as it's a very good vehicle for you to buy into cheap markets and are able to diversify at the same time. Okay, so before I end the session, I would like to share 3 important traits to our investors. Okay, equity markets tend to trend higher over the long term, and market rewards patient and prudent investors. For those of you who have been through 1998, for those of you who have been through 2008, the sovereign debt crisis, you would have known markets eventually trend higher. So why? Because corporate earnings are underpinned by population growth. As population grows, you have more people spending, you have more people producing, and that actually contributes to your profits, and that also drives inflation. Okay, so all of these long-term trends will actually continue to push earnings higher, and with higher earnings, that drives your asset prices. So although it's very difficult to stay invested when you are looking at losses, but bear in mind, over the course of the history, time and time again, we have proved that markets are always rewarding for long-term investors. Then for those of you who wants to time the market, you can try, but usually it's very hard to do that. Okay, market gains are actually built over a very narrow range of good days. So as of 7 April, which have included the current rebound, back in 2010 until the current period, investors who have invested in the S&P 500 index over the past 10 years would have earned an annualized return, compounding rate CAGR, of 10.8% over the past 10 years. But if he or she misses the 10 best days, okay, the returns will actually cut by more than half already. Okay, if they attempt to time the market, go in and out, being affected by news headlines, being affected by negative news headlines, missing all those best days will actually contribute to very poor returns over the long term. So stay invested, assess fundamentals instead of being carried away by news headlines. Then lastly, volatility is also unavoidable. It's always part of the investment landscape. It's always there. It's the matter of high or low. Okay, and in periods like this where you have a very rapid news flow coming from Bloomberg, coming from CNBC, definitely volatilities will be there, because volatility is just the movement of market participants readjusting their expectations based on the new development on the global economy. So when you see a pickup in terms of news flow, definitely volatility is there, but be prepared for it. Yeah. When you invest in something, make sure that you understand your risk profile. Don't go overboard in terms of buying something that you are not comfortable with. Okay. A lot of people have the problem of being very conservative when markets are uh, very bad, and being very bullish when markets are very good. So in terms of managing your profile, you should always be consistent regardless of not markets are bullish or bearish. So we think a risk-aligned portfolio will help you to stay the course. Always have a balance of fixed income as well as equities. Okay, that is all I have to share with you today. I'll be happy to take questions. So feel free to put in your chats, put in your question in chat, and I will try to address them accordingly. The healthcare presented valuations is actually global. It's a global healthcare. We have actually utilized the MSCI Global Healthcare Index. Based on the current charts shown in correction of 2018, is there a possibility that market corrections will continue further? Based on the current developments that we are seeing in COVID-19, we think there are still possibilities that markets will continue to trend lower further. Yeah, because the evidence of virus containment is yet to be seen. We are still seeing growth rates at an alarming rate, but we think market valuations are actually quite attractive now for investors to start building positions into places that they like. H shares versus A shares, which is better? Okay, personally, I like H shares more because in terms of corrections, their valuation is a lot more attractive compared to A shares. But having said that, I think it's fine to have both. Personally, I hold the CIMB Principal Greater China Equity Fund. How do you see REIT sector in Malaysia and Singapore going forward? Okay, I will answer REITs not pertaining to Malaysia. I will answer REITs pertaining to Asia as a whole, because on our platforms, if you want to buy REITs, I think the only accessible one will be Asian REITs. So Asian REITs, similar to equities as well as fixed income, REITs have corrected very sharply. Okay, in terms of prices, because of those shutdown, in terms of movement restriction as well as rental worries. Okay, but we think within REIT space, we are still quite positive in terms of staple areas, retail malls that sell consumer goods, okay, necessities. So these are the places that we actually place more value in. And Manulife Investment Asia Pacific REIT has actually positioned into all these consumer staple REITs. So if you're looking to buy REITs, we think they're attractive. It's worth a buy. It's actually one of our fund choice in last month. This month our fund choice is actually TA Global Tech. Last month our fund choice is actually Manulife Investment Asia Pacific REIT. So if you're looking to buy into some equity income opportunities, you may actually consider Manulife Asia Pacific REIT. You are bullish on China tech stocks. What is your opinion on US and semiconductor stocks? We are bullish. Okay, to correct that, we are actually bullish on Chinese economy, and we are bullish on the global tech sectors, not specific to US tech or Chinese tech. We are bullish on global tech because it's a global trend. Okay, so in terms of opinion on US and semiconductor stocks, we think they are actually presenting themselves at a very attractive valuation. So for those of you who have been waiting for a long time to buy US tech and semicon companies, feel free to do so. But remember, don't go all in. The worst is yet to be over in our view. Okay, there will be volatilities ahead, but start building positions. Start building positions progressively. Have an investment plan in mind. As I mentioned earlier, markets drop by 10%, buy a bit, another 10%, buy a bit. So according to a risk tolerance, start building positions. With the estimated downtrend in market with the bear market at current negative equity portfolio, would you advise to exit when portfolio turns positive? In terms of exiting your portfolios, it really depends on your investment objective. Okay, what do you want to do with the money? Because when you enter the market, you should have established an investment horizon. So let's say I'm putting in this money to fund my European trip over the next 3 years, to fund my education fund over the next 10 years. So you have to assess whether or not to exit these positions based on your investment objective as well as investment horizon. If an individual has a very tight liquidity situation, I understand that COVID-19 lockdown has actually put a lot of strain and pressure on businesses. So remember to assess your financial liquidity, your own personal emergency funds before making investment. Because the worst thing to do is you wanted to buy into a cheap market, but at the same time you didn't expect MCO to be affecting your financial position. So that will actually lead you to prematurely liquidate your existing position. So that is the worst case scenario here. So before you decide to invest, remember to assess what you have now. Make sure you have sufficient emergency funds to weather through rainy days first. Look at your investment objective. If you have achieved your targeted returns, please leave. Please exit the investment because you have made money already. Is it a good time to invest in China equity rather than Malaysia equity? Okay, we think they are both attractive. Okay, but Malaysia, you need to be selective because Malaysia, we are actually positive on small cap instead of large cap. Okay, large cap companies are actually mostly banks as well as petrol giants as well as you have also precious metal, your commodity. So of these companies, the earnings are not very healthy at this point of time, especially for banks. You have record low interest rates, so that will put pressure on net interest margins. So the tailwind, the upside potential, we see a lot more in Malaysia small cap. So if you want to choose between Chinese equity and Malaysia equity, I think you should have both. You have some China and have some Malaysia small cap. But remember, these two economies, or to say these two segments of the part, is actually quite volatile. So remember to limit your exposure. We will actually upload the recording later, so you can actually write into our CIS team to get the recording. Will negative quarterly results in the US affect markets in Asia and China? Yes, it is very likely that negative results in the US will affect markets in China and Asia. That is why we actually communicated the expectation. We say that we expect to see a lot more negative headlines in the next 3 to 6 months. This month in particular, we will be able to have a rough sense of the 1Q quarterly earnings result for the US. What about Asia Pac? Asia Pac as a whole, we are actually quite positive. Okay, and within Asia Pac, we are bullish on China. So if you're looking to buy into core positions, you can actually consider Asia Pacific Dynamic Income Fund to gain exposure to Asia Pac. Do you think the trade war risk to China is resolved? I wouldn't say resolved, okay, because that is too certain, because you will never know what's going on in the head of Trump as well as Xi Jinping. I would say it is postponed because both of them now got their hands tied, especially for Trump. I think he needs to solve. I think he needs to put in a lot of policy measures to contain COVID-19. So another trade war against China will be the last thing that investors want. Is it better to invest in equity funds as compared to bond funds? Okay, Sharon, when it comes to investment, we always advocate investors to have a portfolio. If you are a balanced investor, you should have 50% of your money in equities and 50% of your money in bonds, and you gradually adjust from there. So if you are slightly more bullish on equities like us, have a little bit more of equities, 55-45. If you are more bearish, go 45-55 when it comes to equity and fixed income. That is how you tilt between asset classes. APEC, ex-Japan, US, SB do more promising. Okay, in terms of recovery, we think Asia Pac should be able to recover a lot more than emerging markets, because emerging markets, you have your LATAM emerging economies, you also have Brazil and Russia, which is particularly troubled with the oil prices at this point of time. So if you're talking about recovery scenario, we think it is a lot more optimistic for Asia Pac companies. Is emerging markets still attractive? Yes, but it will take a long time for it to recover. I personally have some exposure in emerging markets as well. How about Affin Hwang China A share? That is actually one of our favorite fund also, but due to its wholesale nature, you need to be an accredited investor to be able to invest in Affin Hwang China A share. So we did not choose to market the fund here. It is a good fund managed by UBS, one of the largest asset managers in the world. Okay, they have been managing Chinese A share mandates quite successfully, and we think it's a very good place. If you are an accredited investor, please consider that fund. Why FSM recommend the principal China diet? This one is far beyond China A shares and all. Okay, the reason is because, as I mentioned earlier, Affin Hwang and M China both are accredited investors fund. So in accordance to Securities Commission's regulation, we are not allowed to market this fund. But if you ask me, I will be able to give you advice. If you are accredited investors, please look at Affin Hwang. Other than China, do you look at other markets now? Yeah, we do. Aside from China, investors should also look at Asia. Should also look at Asia, Malaysia, small cap. There are a lot more attractive markets now, and we will actually gradually put up all these investment ideas over the next few weeks. So do stay tuned to on our websites to read our research ideas. Would your view be the same for global REITs as well as Asia Pacific REITs? What's your take on China? Okay, for global REITs, in terms of view, I believe it's a lot less attractive compared to Asia Pacs. Also, although they have corrected quite a fair bit also, it's actually more of a personal preference here. We do not have a very strict view when it comes to whether global REITs are better or Asia Pacific. But if you're looking at in terms of growth, right, in terms of demand, we think Asia Pacific REITs will have better demand over the long term. And my take on India is that it's quite similar to the overall situation that applies now. We will actually have to monitor the situation quite closely on India. Valuations are definitely attractive for India now, but India has been very expensive for a very long time because of their long-term growth prospects, and people are actually looking them as the next China. So the current drawdown have actually brought valuations to attractive levels. So if you're looking to buy India, yeah, feel free to do so. Remember to not go off buy progressively. Malaysian equities, I mentioned earlier, we like small cap over large cap, so do consider Eastwing Investment Small Cap Fund. What is the difference between United Global MYR and MYRH? Okay, this is not only pertaining to global healthcare. This is also applicable to all other funds. The difference between MYR and MYRH is the hedged word. Okay, so when you buy into foreign currency assets, foreign shares, foreign bonds, okay, you will have the currency translation effect. Okay, so if you buy into United Global Healthcare in MYR, you are actually using your ringgit and buy into US shares. So if USD were to appreciate, okay, you will be able to earn the currency translation gain. But if you are worried that, okay, ringgit will strengthen over the next 1 year, you should go for the MIH class. So you will be able to earn the upside of the stocks, but you will not see any effect in terms of the currency fluctuation. So regardless whether USD go up, USD go down, it doesn't affect your returns. If you buy into non-hedge class, it will affect your return. What is your take on United Malaysia Fund? This fund even applies last year. Is there any prospect? So United Malaysia Fund is actually one of the new Malaysia equity mandate launched by launched by UOB Asset Management Malaysia. Similarly, they also provide exposure towards the small cap segment. But in terms of performance history, they are actually quite new compared to the existing small cap funds available. But it's definitely one option to look at when you are considering to get a small cap exposure. How is Kenangan Growth Fund doing for Malaysia small cap? Okay, the mandates for Kenangan Growth Fund has sort of tilted quite a bit. So for those of you who are not aware of Kenangan Growth Fund, this is one of the flagship small to medium cap fund over the past, I don't know, more than 15 years. Okay, initially it provides a lot of exposure to small to mid cap, but due to its fund size, okay, Kenangan Growth Fund is actually the largest Malaysian equity fund in Malaysia. It is currently sitting around 1.5 billion. Due to its large asset under management, it is not able to completely allocate all capitals within small to mid cap anymore. Currently, it has about 30% into big cap. Okay, so when small caps do pick up, we expect Kenangan Growth Fund to pick up as well, but not as much compared to Eastwing Small Cap or other small cap funds that are available on the platform. What is your view on commodities such as gold, silver, copper, sugar? Okay, commodities is very hard to provide you a very general view, and in fact, gold, silver, copper, sugar, if you're strictly speaking on individual commodities, they have very distinctive characteristic. Gold is people know it as safe haven, but not really safe if you are looking at recent numbers. When market go down, gold markets have also gone down because markets have actually redeemed gold to cover margin calls within the stock markets. Silver is also the same thing. Copper is very reliant on industrial activities. So when the COVID-19 incident happened, your industrial metals like copper, aluminum, all of these industrial demand metals were actually hammered quite a fair bit. So prices have declined quite significantly. So we don't have much view on commodities, but this is something that I can share with you. Which healthcare funds do you recommend? United Healthcare, I mentioned earlier. You can actually view that on our website. Recommend 70 equity, 30% fixed income, or 50-50. This depends on you, Fong. If you are a balanced risk investor, 50-50. If you are moderately aggressive, 70-30. So how do you gauge that? You can actually do the risk profile questionnaire. We actually have a risk profile questionnaire to help you to assess your risk profile. Then you move on from there. Do you think the impact of COVID-19 is fully priced in? Yeah, we have mentioned earlier in the slides, we do not think it's fully priced in yet. That is why we have put in a pessimistic scenario. We have cut down the earnings estimate numbers to see whether markets are still cheap even after not earning that much money. So over the near term, even 3 to 6 months down the road, volatility will be there. Yeah, so I don't think it's reasonable to expect a very smooth straight line uptrend going forward. What about Indonesia Focus Fund? Indonesia is very volatile in nature. It's very concentrated. So, but in terms of growth prospects, we think they are one of the attractive markets within ASEAN. If you compare Thailand, Malaysia, or even Indonesia, key benchmark index as a whole, we are actually quite positive on Indonesia market. So you can actually put in some money into Indonesia if you are bullish on its demographic trends as well as being the largest populated economy in ASEAN. Do you recommend European equity funds? If you compare the upside potential between US, because European countries is actually different markets. So if you compare US, Europe, and Japan, within these three economies, US and Europe are a lot more attractive now. So yeah, that is one thing for you to consider. And PA European Equity Fund is one fund that you should look at as well. We have seen that all the bond funds also dropped recently together with okay, bond funds have corrected quite significantly due to the risk-off assets, but we believe bond funds will recover in the near term. So bond funds, there are actually two categories. I can actually share a lot more on bond funds here. First is the local one. Second is the foreign one. The local one is always a go-to avenue for investors to diversify their portfolio because our institutional participation within the local fixed income market has always been resilient. And every single drawdown that we have seen in the past back then was Trump. When Trump got elected, that is where you see a sharp drop in terms of bond prices, local bond prices. The second instance where we see a sharp correction was the FTSE Russell incident. Do you guys remember back in April? So that has actually contributed to the volatility. And the latest one is actually due in March. Okay, we see a sharp drop in terms of the Malaysia bond funds. So if history is any guide, plus the strong participation of institutional investors, we think bond funds, local bond funds especially, is still one avenue that investors should consider to diversify to. For foreign funds, they have fallen very significantly because a lot of these foreign fixed income funds, they invest in the high yield space. High yield meaning junk bonds, non-rated bonds. Okay, a lot of people are pricing in defaults for these papers. But for investors that are investing in those foreign bonds, we think they should hold on to it because we believe the policy measures that are being put in place and the reduction in interest rate has actually reduced the default ratio as well as the risk of rating downgrade for all these bonds. So if you have positions, do hold on to it. We are optimistic that the prices will recover eventually. Okay, why Afing Huang A shares? Okay, in terms of management capabilities and conviction, we think Afing Huang A shares are better positioned in that sense. M China A, they are a lot more, they hold a lot more holdings. Okay, so if you prefer not to say benchmark following approach, if you prefer a wholesome exposure to China A, okay, you may consider M Alliance. But if you prefer conviction approach, okay, which means that the funds hold a lot lesser investment ideas, a lot lesser investment holdings, then you can actually opt for Afing Huang A shares. So it's more of a personal preference. And when it comes to assessing historical performance, we actually prefer Afing Huang China A shares, which is why our DPMS, our FSM1 managed portfolio actually invest in Afing Huang A shares. What about ASEAN Fund? ASEAN Fund is good to consider as well. You can consider CMB ASEAN Dynamic Fund, if I'm not mistaken. ASEAN Dynamic, somewhere that I don't remember the full name. At the moment, while the market is still bearish, what balance fund do you recommend? Both local and international fund. Okay, for local funds, we favor long duration. So Kenanga Asnita bond is one avenue for you to consider. Maybank Malaysia Sukuk, Amanah Sharia Trust Fund, Amanah Sharia Unit Trust Fund, as well as East Spring Investment Bond Funds. So these are the local funds that you can consider. For international fund, we are currently favoring Asia High Yield. Okay, so you can actually consider buying into East Spring Investments Global Target Income Fund. Yeah. The other high yield funds are actually available to accredited investors only. So if you are an accredited investor, you can also consider those wholesale high yield fund. How about unit trust, money market, fixed income? Should we do mostly at 50%? What do you mean mostly at 30%? You mean equal portion? Money market is part of fixed income. So it's either equity or fixed income. So how much you should allocate should be in accordance to your risk profile. Which is the Indonesian fund to recommend? For investors that are looking to gain exposure to Indonesia fund, we think it's better to do through ASEAN fund because it's less concentrated. But if you're able to stomach the volatility, you may consider Manulife Indonesian fund. I think it is the only Indonesian fund available on our platform. What is your take on East Spring Investment Dynasty Equity Fund? East Spring Investment Dynasty Equity Fund is a good option for Sharia investors that are keen to purchase into China H shares. Apologies for missing that out. Okay, for Sharia investors, if you're looking to buy Chinese equities, okay, for China H shares, please look at RHB Sharia China Focus Fund. For China H shares, please look at East Spring Investments Dynasty Equity Fund. In terms of allocation, any thoughts? Okay, if you want the model allocation in terms of how we allocate between all these countries, right? Please refer to our DPMS asset allocation. Over there, you will be able to see how we divide our portfolios to form a global portfolio. United Global Healthcare Fund, historical fund price return not available of FSM website. How to obtain this information? Okay, the returns are not available because the funds are launched in less than 1 year. So that is why return information we cannot show. So only funds that have historical performance of more than 1 year we will be able to show. But you can actually dig further into the target fund. Okay, you can look into the global. You can look into the fact sheet. If I'm not mistaken, it's the Janus Henderson Healthcare Fund. You can obtain this piece of information and look for the foreign fund fact sheet. I think if it's too much of a work, you can write into our COS team. We will be happy to furnish you with the target fund fact sheet so you have a better idea of the target fund. So although the Malaysia United Healthcare Fund performance is less than 1 year, the target fund, if I'm not wrong, has more than 5 years worth of historical performance already. How about RHB Aging Income Fund, Balance Fund? If you are a balanced investor, if you want a balanced approach to aging economy, feel free to invest in RHB Asia Income Fund. It's one of our recommended income fund as well. Okay, I think we will take one final questions maybe before we close the session. Any more questions, people? Okay, USD swap line, I think it's in terms of managing their liquidities. It's in terms of managing liquidities as well as the foreign currency reserve. So because back then in the 1998 ASEAN financial crisis, what essentially happened is actually liquidity concern when it comes to the central bank's foreign currency reserves. So it doesn't mean that they won't be attacked. It means that they are better prepared for any further stress in the markets. Thank you everyone for your compliments. Do write in to our CIS team